This program is brought to you by Emory University.
My name is Govind Hariharan. I'm the Executive Director of the India-China-America Institute, which was founded by a distinguished professor here, Dr. Jagdish, Sheth, amongst one of his many achievements. Let me do a quick snapshot of what this panel is about, introduce the panelists, and then I'm going to mostly stay out of the way. And so you don't have to worry about the sound again. You know, so many of us have come across scenarios, come across advertisements where you see, you need cash. Do you have a car? Do you have a car title? You can get it converted for cash. Now that's a smaller segment of the population with very different characteristics. Across, you find that in every country, whether it is pawnbrokers, whether it is exchanging your title for cars, whatever it may be, this is a huge issue that there is a large percentage of the population spread out around the world who really do not participate in the financial system, for whom even getting a very small loan quite often involves very usurious rates of interest, whether even when it is for starting a business. In India, according to the World Bank, about 1/3 of the population actively participates in the form of having an account, etc., in the formal financial sector. That means 2/3 does not. There are also sizable gender disparities, differences between rural and urban, and all of this makes this topic of the utmost priority, not just for the Indian government, but for companies such as Equifax, and of course for all of the people involved and engaged in the rural agricultural systems. So this panel is going to essentially look at the issue of financial inclusion. We'll look at the current status. We'll have a presentation on that from a leading expert from the World Bank. We will then speak about future solutions, especially with innovative thinkers like Jag. We'll come up with some unique solutions. That's the focus of this panel. Okay? So without further ado, let me start with the person closest to me, Mr. K.V. Eapen. Eapen knew me back when I had a full head of hair and a big beard, all of that stuff. Much of that is gone. And we were classmates in Delhi. Since then, he joined the Indian Administrative Service and was most recently Joint Secretary of Banking. So in that role, he was placed by the Prime Minister and the Finance Minister in various task forces to help bring about financial inclusion in India. So he's a tremendous expert. We've had him before at the ICA Institute. He's also a senior fellow at the ICA Institute. He's currently the senior advisor to the executive director for India, Bangladesh, Sri Lanka at the IMF. So we're looking forward to his experience, his thoughts, and where he sees this issue going in the future. Of course, Dr. Sheth does not need much introduction and has been a mentor to so many of us that it is actually very humbling to be sitting at the same podium with him. Dr. Sheth is the Charles Kelstad Professor of Marketing at Emory University. He is also the founder and chairman of the India-China-America Institute, has published millions of books and articles on a wide range of topics. And what is unique about him is that he always comes up with something that people hadn't thought of before. And so you go back and say, how come I've been doing this for 20 years and I never thought of this? So we're looking forward to Dr. Sheth's innovative solutions for the problem of financial inclusion and the unbanked in India. Last but not least, we're going to start off with a presentation on the current status by a person who has been at the forefront of the analysis of the data on financial inclusion around the world. She just came back from doing a presentation at the premier conference on microfinance in India. She's currently at the World Bank with the Finance and Private Sector Development Group, received her master's from Harvard's Kennedy School of Government. And so we'll kick off with a presentation by her on what do they have in this really neat data set that they've been compiling, because very little was known about, there was nothing quantitative. We had a lot of anecdotal information, and they've been spearheading that task, as well as the analysis of that. So she's going to present their report first, followed by a discussion by the panel on the findings of that report, the current status, how do you implement it, and what is the future? Okay? My apologies, Atisha Kumar. Thanks. See, I figured everybody knew.
Can everyone hear me in the back? Great. So it's an honor to be here with such distinguished panelists. And what I hope to do here is give a flavor for the research we've been doing with financial inclusion worldwide and in particular in India, and set the stage for a fruitful discussion on the way forward, how the data can inform actual policy solutions, further research, and innovation in this field. So just to give you a flavor of where I'm going with this. So I'm part of the Development Economics Research Group at the World Bank, and we work on something called the Global Financial Inclusion Index. And the Global Findex, like we like to call it that, is a database of financial inclusion worldwide. So I'm going to first introduce you to the database and then explain where we hope to fill the gap in the data, what it tells us about financial inclusion worldwide, and in particular in India. And I'm going to focus on account ownership or account penetration around the world, and also on other financial services like savings and credit. And then I'm going to briefly sort of recap and discuss what are the takeaways from this, what's the way forward. So just to start off, what is the Global Findex? So the Global Findex is the first individual level database on financial inclusion. And we have data for over 148 countries. So it's comparable across countries. And it's also going to be comparable over time. So far, our first round of data collection was in 2011. So we can compare sort of in almost 150 countries for this year, but it's funded by a 10-year grant from the Gates Foundation. So we have future rounds of data coming in 2014 and 2017, which is when we'll be able to compare financial inclusion not only across different countries, but also within a country over time. So how has a particular reform performed within India, let's say between today and the next 5 years? This data is based on survey data, with our data being collected from the annual Gallup World Poll, and we have over 150,000 interviews with adults over the age of 15, and they are representative of over 97% of the world's population. The sample size in India was over 3,500 adults, and it was nationally representative with data points from different states, different demographics, and we disaggregate the data by demographic characteristics such as age, gender, income, education level. So now that I've told you what the Findex is, what does it measure? So it measures how adults can, like I said, save, how they can borrow, how they can consume, how they access and use financial services, and how they make different payments. Let's say a migrant sends money home. So to what extent the financial system allows this migrant to do that, and also how they can manage risk using these financial services, its usefulness. So our database includes over 41 indicators, and these indicators are disaggregated by, like I said, various demographic characteristics such as age, gender, income, etc. So why is this interesting, or why is the Global Findex important, or why is it useful in any way for different academics, or for a policymaker, or for someone in the private sector? So first and foremost, it provides a tool to benchmark the levels of financial inclusion. Like I said, we have future rounds of data, and we have data points for many countries. So you can compare what the levels of financial inclusion are, both across countries and then within countries over time. And you can sort of see what public policies are needed, what public policies which are already in place are working, and where they can be reformed. For someone in the private sector, it can help identify potential clients for financial services, the demand for new products. For an academic, because it uses a consistent methodology over time and across countries, which really didn't exist in this sphere before, it can sort of spark off new research, explore new solutions in this field. And like I said, it's a long-term project, so only the first round of data has been released as of now, but we have future complete updates coming in 2014 and 2017. And this is meant to not only be the only resource. We hope that this will spark off future rounds of data collection by national governments, and this is more of a demand-side survey. So we really hope that it will complement supply-side data on access and on bank branch penetration and things like that. So this project was generously funded by a grant from the Bill and Melinda Gates Foundation, and we partnered with Gallup with their annual world poll to actually collect the data. So let's start off by actually seeing what the Global Findex tells us. So this is a map of the world shaded according to the levels of financial inclusion. And what's interesting is that there's great diversity across countries. So in 23 of the economies, account penetration is higher than 95%. But then you also have about 20 countries where people, less than 5% of the population of those countries even have access to a bank account. So what explains this divergence? If you look at the US, the level of account penetration in the US is 88%. So 88% of survey respondents, or the US's population, said they had a bank account. But if you look at India, 35% only said they have a bank account. So what explains the difference? So let's focus more on India with respect to access to accounts. So like I said, 35% of adults in India, so those over the age of 15, said they have a bank account. How does this compare? So is the US a fair comparison because they fall into different income groups? Let's look at another developing country. So people compare India and China a lot. What is the level of account penetration in China? So over 60% of adults in China actually have access to a bank account, whereas it's only almost 1/3 in India. India's almost at par with the other South Asian countries, with 26% having a bank account, but it's slightly below the average in developing countries as a whole, and it's significantly lower than the average in the other BRICS economies, so that's Brazil, Russia, China, and South Africa. Why is this? Why is this gap there? That's what we're trying to spark off a question, trying to explain why the level of account ownership is lower. So the average account penetration in developing countries is 43%, but just to go back to across country comparisons, the average in high income countries is 89%. So that was diversity across countries. What about within India? Do different groups access or use financial services differentially? So let's start off by the basics of demographic groups. Gender. India has the largest gender gap in account ownership in the BRICS economies and also in the South Asian countries. So the gender gap is actually 18 percentage points. So while 44% of men who were interviewed said they had a formal account, only 26% of women said they did. Why is this the case? Across different age groups, you can see that younger adults have a lower rate of account ownership than older adults. So that's people between the ages of 15 and 24 have less use of financial services than people above the ages of 65. Why is that? Between the different income quintiles, so the poorest 20% of India's population, out of them only about 20% can use financial services, whereas the same number, if you ask the richest fifth of the Indian population, is over 50%. Of people with a tertiary education or higher, 76% will tell you that they use a formal bank account. Whereas if you ask people with low levels of education, so primary educations or less, only 31% have a bank account. Why is that again? And then you see a significant rural-urban gap. So we also asked the non-account holders, why was it that they didn't have an account? And what we saw was interesting. So in India, there was a unique reason, which we didn't see in many other countries, why people didn't have a bank account. The reason was that another family member already had a bank account. And women were more likely to say that, which throughout the conference, I think we've been going back to the theme of gender. And it's interesting to see how it comes up in this sphere as well and what it suggests. I mean, one possible hypothesis could be that there's just less intra-household bargaining power that goes to women, or it could be that women don't sign up in their name in the bank account. There could be a number of reasons. Another commonly cited reason was that people didn't have enough money to use a bank account. And this wasn't unique to India. So throughout the developing world and throughout the world as a whole, that was the biggest reason why people said, over 60% of people said, because they didn't have enough money, they didn't see the need for a bank account. Other commonly found reasons were lack of the necessary documentation and also the high costs of accessing a bank account. So let's focus on two of those reasons. I'm going to first talk about documentation, and I'm hoping after I'm done with the presentation, we can talk about some of the common public policies that India has undertaken to make the documentation requirements a little easier and to lower the costs of bank accounts for its population. So with respect to the number of documentation requirements, many countries have know your customer requirements, KYC requirements, and many countries do this for anti-money laundering purposes or to sort of have more secure access to financial services. But often the people who are most vulnerable and can't access a bank account for particularly this reason are the poorest, because think about it, they don't have forms of identity, they don't have proof of residence often. Often the urban poor are migrants and don't move around and wouldn't have access to this. Or often it could be as simple as they don't have a secure place to store their documents and can't produce them. So many poor people don't have these documents required, and it's a significant hurdle for them to open a checking account or a savings account for this reason. And when we asked people both subjectively and objectively what was documentation a significant barrier, they said yes. And both of these subjective and objective measures led us to believe that this was a huge issue. The Indian government has done a number of things to sort of ease these documentation requirements, which I'm sure we'll talk about when we get to the panel. But what effect has this had? So we're hoping that this data can also shed light on this as future rounds are made available. The other barrier that I'm going to talk about first is high costs. So high cost could be anything from, let's say the bank branch is too far, to the minimum balance requirement of a bank account is too high for someone with a low monthly income to even open or even think about. And again, the government of India has undertaken a number of policies to overcome this. For example, they've mandated rural bank branching, or they've mandated minimum fee accounts or no-frills basic accounts. And reforms like this have met with mixed success. And I'm hoping we can talk about that a little more as well. So from accounts, I'm going to move on to something that's been a little more innovative and which hasn't met with much popularity or success in India so far. And that's mobile money. Money payments in India, when we asked people, only 4% of the Indian population said that they used mobile money at all to send or receive payments or to access any sort of financial services. This number, if you look at other developing countries, and particularly other developing countries in Africa, this number is huge. So the case of Kenya is a standout here. So 68% of adults in Kenya say that they used mobile technology driven by the early success of M-Pesa in particular. And if you look at South Africa, you can find other examples like Visit. So why is it that it's working in other parts of the world and it's not working in India? One particular reason could be regulation, but then it's complicated. So you have to think about what is it about the model that's working or not working, or what is it about characteristics of the Indian population that it's not taking off as much as it is in other parts of the world. So beyond mobile money, what else can the global findex tell us? So I'm going to look at two other forms of financial services that people commonly access or use, which are savings and credit. So let's look at savings. So India's mostly at par with the rest of South Asia, and it's only a little below the rest of the developing world when it comes to its savings rate. So 22% of adults in 2011 in India said that they saved in the past year. And while this is a little higher than South Asia, it's significantly lower than the other BRICS economies. So why is it that people are saving or not saving? One thing we found when we went into sort of the data pilots and we were seeing the data being collected from the surveyors is that people in India often will save using informal means. So they'll save under the mattress. Or if you ask them, some of them won't be willing to tell a surveyor that they're saving. So you see disparities both within India and then across countries as well, as this data shows. With respect to credit, is how many Indians, what percentage of the Indian population actually borrows, what are the sources of their borrowing, and what do they use the money that they borrow for? So we found that 8% of Indian adults borrowed from a formal financial institution in the past year, and the reasons for borrowing varied from emergency or health reasons, paying school fees, paying for a wedding or funeral. So what we found was the most commonly cited reason for borrowing was for an emergency or health reason. We actually found that school fees and weddings or funerals weren't that high in India as compared to other countries, other developing countries in particular. What were the sources of borrowing? So we gave our respondents options such as you could borrow from a formal financial institution, or you could borrow from informal sources like a community savings club, or you could borrow from your friends or family. And we found that in India, like in the rest of the developing world, friends and family were one of the most common sources of borrowing. So just to recap, I've talked about both account penetration, savings, and credit. So how people in developing countries and in India in particular use financial services, and where this is going, where there's a role for public policy or private sector intervention. So what do we look for in our future rounds of research and our future rounds of data collection in 2014? So we want to, in particular, see how reforms that are already in place are working, in particular for the most vulnerable. So how they're working for people who live below the $2 a day poverty line, how they're working for women who access bank accounts less than men, how they're working to overcome the barriers in account access such as documentation or cost, and how they're working to innovate and actually bring in new means of accessing financial services, such as mobile money. I think that's...
Thank you. So, at this point, what we'll do is, given that backdrop in terms of what is the current status of financial inclusion in India, we're now going to turn to the panel. I'll throw one or two very broadly stated questions, and then we'll open it up for a bigger
Before
discussion.
that, can we clap?
Oh. See, that's two things already. The first panelist pointed out that I didn't mention her name. My apologies there. So thanks for a great presentation. This is, for those of you who are not familiar with the World Bank's Findex reports, what we saw, this is the first one that's just been released. So we are one of the first to see this, the Financial Inclusion Report on India. And so it is a great pleasure to hear about all of this great work. At the ICA Institute, we had a panel on this topic last summer, and we've had a couple of reports, some of which were based on the Findex database as well. And so I want to turn now to some things that came up then, as well as the current status of regulation from a person who's been deeply involved in this, Mr. Eapen. So if you can tell us a little bit about what you see in what your experiences were, especially in the context of the presentation that she made, and we can begin the discussion.
Thank you, Govind. It's a pleasure to be back in Atlanta, not at your school, but at Emory this time. So I thank Jag for inviting me, and of course, the presentation by Atisha has really opened up the issue. I think perhaps this is an audience which doesn't know much about the issue, really, in the sense of what exactly was the problem relating to financial inclusion in India, and is it really a problem? I mean, it's not, one thing we have to remember as a backdrop, I think, is that it's not that Indians have had no access to credit at all. I mean, they might not have had access from the formal sector, which is what Atisha really pointed out. What is the level of formal sector financial spread in the country? But traditionally, there has been informal credit networks which are age-old. And this, of course, I'm referring to the money lending class, which is part of Indian culture and ethos, part of stories, part of literature in India. And I'm also talking about, many communities having their own credit unions where groups and communities come together, and they have, particularly the business communities in India from Gujarat and from other places, who always had their own internal resources which helped them doing their business and trade. But having said that, there is no argument that the formal financial sector needs to grow. It's part of development. It needs to actually spread across the country, and that of course is something that nobody can really argue against. Coming to your report, Atisha, which is, I guess, because it is something which is spread across so many countries, it is important also at the same time, when you do a report like this at a certain macro level, it is also equally important that you don't lose sight of country level characteristics. And if at all have a little criticism on the report, is that perhaps certain specific characteristics in India are not sort of highlighted, because you are going from a cross-country kind of analysis. You want to compare 120 countries all together, and perhaps you don't really see the unique patterns in India. I'll be specific on this. The data that you have got basically covers what you call formal financial institutions. Now, what is a formal financial institution? As per your definition in the report, it means a bank, a credit union, a cooperative, a post office, or a microfinance institution. Now, the problem in the Indian context is that all these institutions, by regulation, don't provide the same services. For example, the post office mostly provides saving services. The microfinance institution is not allowed to take deposits. It can only lend. So, it's only the bank, if you are really looking at it. Cooperatives, some cooperatives can lend, some cooperatives can take deposits, but some cooperatives can do either one of the same. So it's only the bank really which provides the entire gamut of financial services. So beginning from that premise, the rest of the data which you talk about really suffers from that particular problem. So I'll give you an example. For example, when you looked at the spread of account penetration in various Indian states, you found that Andhra Pradesh has an account penetration of 50% compared to 40% in Gujarat and Kerala. I mean, this didn't strike me as sort of intuitively something true, because Gujarat, large population outside, all over the place, they would need to send money back. I would have thought that there would have been more formal financial institutions and good cooperative culture in Gujarat. I would have thought that they would have had more formal financial institutions. Kerala too, large migrant population across the world, and a big cooperative sector, high literacy rates. I would have thought that they would have had more formal financial institutions. But then the data says that Andhra Pradesh has got higher. And I guess that is because perhaps most of the microfinance institutions are located in Andhra Pradesh. So your data might have got influenced by that fact when you did the survey, that the microfinance institutions being located in Andhra Pradesh, it might have had a sort of a effect on that. But the fact of the matter is that the institutions in Kerala, or in Gujarat, the formal institutions provide the entire gamut of services. They provide all the services, whereas the microfinance institutions in Andhra Pradesh only do lending. They don't provide everything else. So this is something, as a policy maker and as a sort of as a policy user, really, or rather a practitioner, what we can use in practice, these are kind of some of the issues which will come up from that. And I think you should refine these aspects perhaps as you go on. On the gender gap, on the variations by age, income level, and education, I think these are absolutely intuitively expected, because if you take every other indicator, you have the same gender gap. Whether you take access to healthcare, whether you take access to education, you will have very similar gender gaps between, in the population, and that is not sort of surprising to me. Now, let me just kind of probably spread the discussion a little bit, or should I come to that later?
Go ahead.
Okay. So what is the government doing really with and the Reserve Bank of India to look at these issues, and how do you think that, or should we go ahead? There are two issues here. One is that the government has kind of taken what I always call the supply side approach. It felt that if you sort of spread the banking network across the country, if you sort of allowed people to have access to bank accounts or to bank branches, it will result automatically in the spread of credit, in the spread of literacy, of financial literacy, bringing people into the financial system. In a way, that was perhaps only one-sided, because as you know, financial inclusion is just not, just spreading institutions. It needs a huge amount of education, what we call financial literacy in many ways, across the population, and also to break down many traditional structures of money lending, credit, and the entire credit culture that is there in the rural areas. As Atisha mentioned, this policy has had very mixed results. In a sense, you have a large number of institutions which are formally present in the rural areas, a large number of no-frills bank accounts where, even all those documentation requirements that were mentioned, they have been allowed to be sort of, they have not been allowed to be sort of standing in the way of opening an account. But the fact of the matter is that most of these, almost half these small balance accounts or these no-frill accounts are lying dormant and they're not actually used. The only use that they mostly have is basically for the transfer of wages under certain government programs, or for the pension transfers under, the old age pension transfers under other programs. So basically the rural population is using these accounts only to get money, but they are not using these accounts to save money, nor are they using these accounts to go to the next level, which is basically to get credit for whatever needs that they have. For those things, they still go to the traditional networks or to some other institutions like the microfinance institutions or some other informal networks. So that is one problem. The second problem is regulation has not kept up with the requirements. And this is particularly so in what was mentioned, that is the transfer of funds. It is a no-brainer that, using mobile telephone technology along with the bank branches, and the fact that there is a large internal migration in India. It's not just external migration. There's huge internal migration in India. So how do people send their money back to their villages? The best way would have been to use, and everybody has a mobile phone in India. It's part and parcel. Even the rickshaw puller has a mobile phone. Now, we could have used that with the banks little better in getting the mobile telephony to work with the bank accounts. But this, unfortunately, I think regulation has been very, very, very slow on this. I understand that things are going to happen, but we've been hearing about that. And to a large extent, this is something which I wouldn't like to blame the government, because I'm from the government. But it is, but it is actually something which has to be mandated by the central bank. The central bank is in charge of money transfers in India, and the Reserve Bank of India perhaps needs to be more proactive on that aspect. So these are some of the 2 points that I wanted to mention as a kickoff.
Thanks, Eapen. Thanks. That's a tremendous background in terms of the government and some of the institutional structures. At this point, I'm going to turn into the innovator, Dr. Jagdish Sheth.
Okay.
Dr. Sheth, if you could give us your view on this topic, actually looking at some of the data that
Yes.
reminded me of some of your studies in describing products and brands.
Exactly.
And the issue of financial literacy. How do you get people knowledgeable about the benefits of banking, the benefits of developing a credit profile, benefits of saving?
Yeah. No, I think it's partly typically the supply side structural problem, partly it's a marketing problem, such as increasing awareness, education, branding, and I think Eapen talked about, and I think it was in the presentation also. I'll take a little broader view first and then come down to very specifics, First of all, the base of the pyramid, as we define as $2 per day income, needs redefinition. The market is very large, and in many other industries, people had ignored there as a market because it was unorganized, it was satisfied. So cell phone industry is my view. When we worked for the Department of Telecoms, before we created the BSNL and MSNL, we found that in rural population, there was a very profitable business if you offered a landline telephone before the cellular telephone comes, into making a merchant into a livelihood mechanism, the TDS and whatever we call, and a franchise model. Most successful, most profitable business for a telephone company in India, government bureau, was in the rural India market. Today with cell phone, it's a done deal. Okay? Think about that one. So I think there is market is there. Size of the market is just too large that not to participate in a more what I call the formalized way. It is not the oppression of the lender. I think that's one side of the story, but there is a very systematic good lending practices also by the informal or the non-organized sector. I mean, if you talk to Shriram Group in the chit fund business, if you talk to Tyagarajan as the founder, I mean, he's a Loyola College graduate, money lending is the business, but at the same time socially responsible. So we cannot blame all money lenders as being bad people. I think we have our own mindset problem. That's the second thing, which I'll come in some depth to some extent, you know. Here are the data which are opposite of what we see. I got very curious about base of the pyramid market, which is not a rural market. Rural market is more than that, which I will come to in a moment. But we are talking about really what governments or world bodies define as sort of the poverty level, right? India has imported legally and illegally about 1,000 metric tons of gold, which I've tracked from 1950 to year 2000. It's averaging about 1,000. London Metal Exchange has the data. The 1,000 metric tons gold, only 25% has ever left India in terms of making jewelry and exporting it out, wherever the markets are. So if you take 1,000 metric tons of gold, multiply with 2,000 pounds, we have 100 million pounds of gold in India. If you multiply with 16 ounces and $1,000 valuations, more than that, it is slightly more than $2 trillion of somebody's cash tied up in gold. Take the 25% off. 70% of that gold is with that base of the pyramid population. It is not with wealthy people. This is, in other words, a negative correlation between lower income possessing gold as compared to upper income, which is opposite of one will think. This is their savings mechanism. It is not a banking mechanism. We need to understand that. And by the way, the only way you can get a feel is to go to the bazaar during festivals like Pongal in South India. And in Chennai, if you go to T Nagar as a suburb, all villagers come there to buy. A typical village woman after marriage, first thing she wants is a sari, which is for festivals and occasions where she can show off the married family. You know, in other words, her husband looks better. The second thing she wants is gold jewelry. Who said they are poor? Well, where we have an analog. The largest banking today in the world is not Citibank or JP Morgan or any one of the ones that we think about, but it is Japan Post. The total assets with Japan Post is $3 trillion. Who are they? They are the poor Japanese. Remember, Japan also has a disparity, like all countries will have. This is the rural Japanese who saved their money because they trusted the government. It's like treasury bonds for us in some fashion. And the Japanese government took all that money, and the Japan Post money by Ministry of Finance was diverted toward funding large zaibastus, which are multinational global corporations, for export-oriented economic growth. So Mitsubishi Group, Mitsui Group, they will get that money. Finally, Japan Post is now allowed to be a standalone through regulatory change, a bank. It can flex muscles now. It is the same thing. We never looked at Japan Post as the largest bank in the world with $3 trillion of assets. So you have that phenomenon. Second phenomenon, it is more recent, is that in the rural market, especially the land prices have just skyrocketed. If you think it is near Bangalore, which is a rising city, Bombay, of course, is constrained. Delhi, typical, no, this is in Kutch, in a desert place where I come from. You could not give away the land for like 5,000 rupees per acre, whatever the equivalent is dollar. Today, that land in the same location is at least 10 lakhs. And the land is owned by the poor, surprisingly. land reforms, whatever the reason is, they're all very wealthy. But that's not cash wealth, not income wealth, and not income. Third, you take a typical Bangalore software engineer, works for a company like Wipro, Infosys, is making maybe 30,000 rupees per month, maybe 40,000 now. But the cost of living is so high, especially rental, that unless he has a roommate or is married and both have to work, they can't have cash flow even. And you go to Kutch, which I have visited recently in Gujarat, the crane operator is earning now 65,000 rupees a month salary. He's high school or less educated, lives with a family, so he doesn't have this extra home cost. And all the money that he's earning is savings. Now, he can waste it on gambling and alcoholism. That's a separate issue, which is a small percentage, and that money is all waiting to be tapped. So the problem is, market is there. You have the land price market valuation, you have the wage increase valuation, and who has discovered these markets where same people are spending money? If you look at India, the rural economy in consumer markets is growing almost twice as much as the urban markets. Largest sales of motorcycles now is in rural India, by the way, not in urban India. Largest number of cell penetration is now more rural in terms of growth and penetration because the population base is there. And finally, after C.K. Prahlad's book on fortune at the bottom of the pyramid, which influenced the FMCG sector, which is the food companies primarily, the toilet, etc., the soaps, etc., they're all now targeting that market and creating a viable business out of that one. I sit on the board of Wipro, as most of you know. Wipro has a consumer products. We have a brand name called Santur. It's all public information. Santur dominates the rural India. They never thought about that one. Now, what's the bottleneck in the rural or that is, there's a huge socio-political institutions that control that market. That is true of the Dharavi slum, for example, or Rio de Janeiro slums, There's a whole another set of merchant groups or channel makers that come in the way. You have to co-opt them. And that can be done very easily. Just to tell you another side, which is unrelated to India, but I think this market is there in India, but we have never analyzed. Last July was very fascinating. I learned that halal market worldwide is $1.4 trillion economy on the sidelines, and no organized sector has ever talked about the halal market. Now, we think halal market is for food consumption to be certified like kosher. Out of 1.4 trillion, 800 billion is all money lending under faith-based approach. Largest institutions that certified halal is in Iran first and Malaysia second. So what I'm saying is that market is there. Let's not debate about that. These are not oppressed people. I think we as educated elite class exercise our elitism over them. We look upon them as if they should behave like we behave. I did a paper in the 70s on consumer protection the same way. Most consumer protection efforts failed in America, including unit pricing, because we took the view as educated people, that is what they should read. They are illiterate, they cannot understand the pricing mechanism by packaging, marketers are deceptive, and therefore if you give them unit price, they will easily buy accordingly. Absolute deject failure in the state of Massachusetts, which was mandated, and the whole government backed off. There is a disadvantaged segment in America also where we have had a massive failures because my view is that it's not the market but our own perspectives. So there are three areas where we need to change. One is basically the structure. Who said that you have to have typical branches? But banks are organized around branch model because that's historical. And branches are very expensive to open. And I think as Eapen mentioned, and I think what you mentioned, Atisha, I think in India, probably the one that rises, that does not recognize regional disparity, like Andhra Pradesh versus Gujarat versus Bihar, does not recognize gender disparity, does not recognize urban-rural disparity anymore, or any other disparity, including education that is in the data, or age, or income, turns out to be the mobile phones. If I was a public policy maker interested in creating unorganized into organized, I would go after that. Remember, same cell phone guys are in most rural populations selling cell phones. They've created a merchant system. Panwalas are able to do a cell phone in those little towns, Bidiwala, Panwalas. I think we need to think banking being distributed differently. Access can be provided very quickly, in my view. So what it requires is, as I think Eapen mentioned, and I think in your presentation, you mentioned that if Kenya can do it, it was through a government intervention of some sort. It was not a market process, it was a policy change. I think one can do the same thing, that if we can have the TRAI, which is the telephone regulatory body, and if we have the RBI, and this is a private sector who really gets into the cell phone business a lot more than BSNL, for example, which is a government enterprise, I think this can happen instantly almost. The banks are not ready. Problem is not the customer or the consumer, they are ready. Banks are not ready. In fact, let me tell you why I'm saying that thing, because we have a postal franking company in America. Remember, you don't have to take stamps. I forget the name of the company. They deal with postal systems of the world. Pitney Bowes, exactly right. And Pitney Bowes came out with a mobile transaction device, absolutely affordable. It's like Akash, a tablet counterpart. And it was very possible for them, it's a mobile essentially, through wireless technology, to do complete banking transactions in addition to postal transactions. And I took them to India. And we found the problem was not the market again, problem was every regulatory agency is having an elitist attitude about the segment. I must tell you that we still have a caste system about the lower socioeconomic classes in India, more so than any other place in the world that I feel. Educated people simply says, lifting something of their own is not my job, it is somebody else as a servant should do for me. I think it is that attitude that comes in the way. Once we open up our mind to say, these are our future customers, they are our livelihood in some fashion, you're going to see a change. So it's a mindset problem, clearly. I see that thing because as bankers or traditional organized sector, we have always looked down on unorganized sector. Anything we have done, from luggage industry, for example, to anything else. So converting unorganized sector into organized is a very key initiative, both by public policy, industry, academic, and I would say probably government involvement. It can be done. I think it's a matter of just getting the will to do it more than anything else, And I will tell you, the unorganized sector is receptive to the idea. It's very interesting. If you talk to Shriram Group, they're very interested. In fact, I believe the chit business guys, which is about a $35 billion business that I know, if you put a whole country together, at least 35 billion. Those guys will do it anyhow. They're going to go technology intensive, as opposed to, and it can be done through the mobile phones or some other devices. So that's clearly one. I also think that we really need to have another perspective on the whole market by learning from other industries. In other words, if banking was less and less compliance-driven in terms of everything it does, and a more and more entrepreneurial market-driven, which some banks are trying to do, I think this segment is waiting. So we can learn from FMCG how they did it, cell phones how they did it. And I tell you, one institution that did it long ago, and we never study them as a part of this whole thing, is our Life Insurance Corporation of India. they were mandated to go in the rural market and sell policies. Every lower socioeconomic class that I know, other than very illiterate tribal people, you ignore them, they created an agency system and they got the savings of the people into life insurance policies. Last comment, we have looked upon this segment primarily from a savings view in different institutions, or a lending, which is the micro-lending side, for example. There is a third element which data shows you, which is business livelihood, merchant class, both consumers and merchants, etc., which is a very large possibility. And of course, their use of the money for education or for money transfer, etc. But the best use I think one can do is to think about how one can create wealth for the poor, which is an asset side of the balance sheet, not the income side of the balance sheet. So if we can think about how can increase their wealth constantly, and we do have wealth management practices. Who has learned how to leverage frozen assets and make it into semi-liquid? I mean, we have all kinds of things that are possible, but we have not thought about how. We always think about these guys are poor, they will remain poor for the rest of their time, they will be struggling, they will be always borrowing money. I would say take the opposite view. They're wealthy, and how can you make them more wealthy? If you think from that perspective, suddenly the mind changes. And by the way, there are companies in India who are doing it, which is interesting, but they are not a part of the traditional banking sector. Okay? I just want you to be aware. I'll stop here. We can pick up any questions. Thank you.
Fantastic. See, I told you, thinking outside the box, innovative solutions. There's nobody better than what you have here at Emory in the form of Dr. Sheth. Let me just give a minute for a quick wrap-up and any additional comments by the panel, and then we'll open it up for your Q&A. Starting with Atisha.
So I think a lot of the points raised have to deal with the distinction between formal and informal financial services and how we define them. And it's important to not only distinguish between them, but also not make a value judgment on which one is better or worse. I feel like in the Indian context or any other context, that'll be context specific and both will have some sort of value and it'll be a differential value. So it's important for any policymaker to focus on both simultaneously according to the country's needs and demands. And with the Findex data, what we've done is we've attempted to capture, for the most part, formal financial services, but we've also sort of asked some questions about informal lending or informal savings or informal use of financial services more broadly. And we haven't gone into the subtleties as much into the informal sector as much into the formal sector, which might be relevant in this case.
Yeah, I think I just wanted to borrow a little bit from what Mr. Sheth, Dr. Sheth just mentioned he mentioned two things which I think are very relevant. One is the sizable amount of gold that is in India, which is like just lying there. And the other one is about, he mentioned the Shriram group, which is a group which is like doing a lot of what they call chit funds, that's lending against other assets. Now, these kind of companies are actually recognized. The companies who use gold as a collateral for lending, or the companies who take in deposits like Shriram, are recognized by the Reserve Bank of India under a class called non-bank finance companies, as you're aware. Now, non-bank finance companies are an important part of the whole landscape, simply because most of them, their business actually is in rural areas. The Shriram group, for example, again, or the Sundaram group, all these groups actually do a lot of what is called tractor loans. They do it seasonally right across the country, and they are present in villages, in much more than even the formal sort of banking network is present. A similar thing is the gold loan companies which have come up. There are 2 or 3 major ones. They are actually using that gold to lend, to give loans, mostly for consumption-driven loans, but definitely they are part of the whole structure. Now, all these companies already have an experience of the rural market in many ways. And the interesting thing is that just this morning, the Reserve Bank of India has issued guidelines for approval of new private banks. And in those guidelines, this morning, and you know, if any of you who graduate from here want to set up a bank, perhaps this is the right time. These guidelines actually give a priority to those who are non-bank finance companies. So these non-bank finance companies in gold loans and all can probably graduate into being full financial services institutions. That is, they can take deposits, they can create products, financial products, they can spin off many other things. So it will be a completely new situation very shortly. And I think that is something I just wanted to highlight also.
Thank you. Yeah. Okay. Open up for the question.
Yeah, let me just make one quick comment, and then everybody else will open up for questions. In regards to your excellent comments, I mean, once again, it was a learning experience listening to all this. I thought I knew a bit because we've been studying this for about a year, this particular topic in the case of India, China, and the US. And every time I listen to the 3 people at this podium, I learn a bit more. And so go back and modify my reports further. One of the things that we found, because you were speaking about the fact that there is all this wealth there, you cannot really think of this as being not being part of a system, is that we didn't find much of an effect. When you look across countries in terms of how much does financial inclusion increase, what type of an effect does it have on economic growth rates? We didn't find much of an effect in the case of India, which was very shocking to me. And your point may be the reason why. So I'll go back and rewrite our report now. So let me now open up for very quick, targeted questions. Please make it focused to one person in the panel.
Before that one, I do want to mention that the rural India today does not want to buy unbranded products, which is just the opposite of what we thought. They really want branded products. And my view is that therefore anybody who can learn how to brand and package and market this stuff,
Small packets.
whether it's our unorganized sector or organized, makes no difference, will make a difference, I think, you know. So I think one has to have the excitement that one can create about this industry. I also have a second comment. I think our traditional ways of rating them, as we do here, I think we have to have a different perspective. Should we be rating them on their income, for example, or should we be rating them on something else? You know, about risk-taking. It is a risk management business, but I think our system of rating is not compatible with this segment of the market worldwide.
Please.
It is my understanding that during the Mughal period, the reign of Akbar in the 17th century, about the time of Elizabeth I, that 60% of the gross domestic product of the world came from India. And it appears that now there's a lot of wealth in India in various locations. Could you contrast the situation then and now, and are there lessons to be learned from that?
I'm not a historian.
No.
That's beyond our pay scale.
That's a hard question to handle at this point. So let me see if we can all ruminate on that, and we'll come back to you a little bit later, if you don't mind. Yes, sir. Next question.
I think it's incredible that this data is being generated and used, but at the same time, I'm wondering, are states within India learning from each other as well as trying to learn from other countries? You've mentioned that there are very large disparities between states in India, and are states in India learning from practices and policies that are already in place?
So our data, even though it's So that's a great question. Our data does capture disparities between states, and we do have a significant number of observations for certain states to learn that. But if you look at sort of just the regulatory picture and how different policies have performed differentially across states and how the government pilots certain programs in certain states versus the other, there is definitely some sort of learning curve. But you also have to recognize that these states are also very different. The economic situation, the social situation might be very different in, let's say, a Kerala versus an Andhra Pradesh where there's microfinance, and Kerala has a high literacy rate. So the take-up of certain products versus others might be higher in one state versus the other. So although there is room for learning, there's also room for state-specific policies, or there's also room for differential financial sector use across states.
I agree.
Next, please.
Good afternoon. This question is directed to Professor Sheth. How do you think, first of all, I applaud your views on innovation and financial inclusion, but how do you think these could be used to maybe apply to Vijay Govindarajan's concept of reverse innovation? Yes. These financial inclusion in developing countries, how do we maybe implement that, or how do they apply to developed countries?
It is already happening. It's very in an interesting way. The Grameen Bank success in Bangladesh, and of course its limited success in India, actually is a very flourishing concept for the same base of the pyramid market in New York, Chicago, and I think they're about to open a Grameen Bank in Atlanta, for example. Because you have that unbanked sector there also, because they don't meet the credit requirements, based upon the 3 credit rating agencies. And that's a very large and highly profitable market, surprisingly. So it is not done for charity, but it is done as a legitimate lending business, for example. And not just for social entrepreneurship. Grameen Bank does everything now, as you know pretty much. Although it began, and Muhammad Yunus has become quite fond of the city, Atlanta, pretty much. So to me, that's clearly reverse innovation, just one example. I think there is something, I have been always very fascinated about LIC, Life Insurance Corporation. It has done more product innovation on life products than anywhere in the world. I worked for about 6 different life insurance companies worldwide. More innovation has happened there, and I think we will learn quite a lot more how some of those products may be equally valuable in advanced countries, for example. And US is very much insurance-centric industry, culture, I guess, pretty much. So that's the second example. Of course, GE's article, what they are doing in medical instruments, for example, is another one. So I see the trend clearly happening. I think it's a question of change in the mindset of the CEOs of the companies. For the first time I have found, after 40, 50 years, Unilever CEO now says that my future lies with emerging markets. I've heard the same thing now, for example, from CEOs of other packaged goods companies in general. I think once they decide that these are not as risky markets as they think, political risk, for example, market risk, whatever they are, suddenly the excitement has now come from the top down in the organization. This is how it works, unfortunately, in the Western world, where the CEO says, it's my mandate agenda, and suddenly everybody is investing. Colgate-Palmolive is massively investing into the emerging economies now, pretty much, which is interesting. And if you attended the retail session before, and I'll just quickly summarize, we had a presentation in my academic department by a top scholar. They did research in Mumbai, and they found that the modern retail is more likely to be penetrating lower socioeconomic classes than upper socioeconomic classes against the traditional neighborhood grocery store person, which is interesting, almost opposite of what we think generally from our economic perspective by and large. So there's a lot of potential. I totally agree.
Okay. Thank you, Professor.
Let's take maybe one question on each side, and then we'll stay back for the rest of you because the Consul General will be in a minute. Okay. That session starts at 4:45.
Well, he can raise questions for us too.
Yeah, he might.
Okay, I just want to bring up the topic of government regulation and how they work with these private sector finance institutions that are growing so rapidly. And then specifically, I'd like to bring up the AP Act, which was passed in Andhra Pradesh in 2010, shutting down all microfinance practices, I'm sure you know. And I'd like to ask you to speak about what kind of compromises that has forced the Indian financial inclusion agenda. And in light of that, what role do you think the government should appropriately play in developing these policies and regulations to make sure that they're not hindering any sort of unjustified growth in the sector?
Tough question. Yeah, well, yes, the microfinance industry, everybody knows in India, is basically located in and around the state of Andhra Pradesh, in and around Hyderabad to a large extent, actually. And it really grew out of actually government policy. There were the state government, when Mr. Chandrababu Naidu was the chief minister, spawned a lot of what is known as self-help groups, which were groups which were basically of women. 80% were, I think, 80 to 90% basically women's groups, which actually did loans to each other. The microfinance institutions got into the act later, and many of them were actually set up by people who returned from the US. And you know, initially they started in the traditional way. They lent money to these self-help groups. They co-opted to these self-help groups. They kind of grew the market more. But over a period of time, you know, this is a very complex situation. Some of them started thinking of going onto the stock market, listing themselves as companies. It became a completely different model. They became just like any other, like, you know, investment bank or something, and they were like looking for private equity placements from all across the world. It was going into a particular path. The state government obviously was concerned. There was a large number of reports of repeat lending to the same group from the companies. There were large number of reports of suicides by people who had borrowed too much. So all these kind of situations where situation actually caused the Andhra Pradesh government to promulgate their act, and it has made a very big difference to the industry. Over the last 2 years, what has happened is that I think this has been for the good. You know, there has been a sort of a shake-up. Things are getting more settled. The Reserve Bank of India is actually taking more interest now, rather than just leaving it almost unregulated. So that has also happened, and they're taking a kind of, you know, the kind of regulation and the kind of interest that lets the sector develop, but under certain proper rules and regulations. So it's overall, I would say that the experience of the microfinance sector in Andhra Pradesh is positive.
We'll take one last question.
This is a completely off topic. But if you've noticed, the middleman industry in India, the ones who take money, literally streamline, lobby for my government license, driver's license application we process up front to the line and everything. They basically streamline. You see them everywhere, from education to government institutions, everywhere. But I've never seen any in the financial institutions. In the sense, people who are there to streamline applications for poor people and get them to the banks. What do you think of their potential, and why is it that you never see them in that industry?
Well, I know they have answers also. My view is that I think it's nothing with the customer side. Market is ready. It turns out to be the providers of financial services, traditional banks, for example, have their own compliance problems. They can't accept somebody's account based upon whatever, you know, is submitted, which is the documentation aspect that you talked about. And most of these people have no documentation. I also think that when you compare and contrast with China, so there is a market, but it will not be as large as we think, is my conclusion here. But if you look at China versus us, and I think the numbers were shared, but China in transition from a traditional society to a communist society took all the private property rights away. It belonged to the state. And they probably computerized or recorded better than we have done. In India, unfortunately, a lot of wealth will be tax avoided. Even today, you cannot buy a home any place, even in rural market, without having 60% official and 40%. It's the legacy of our license Raj, where we taxed people on this indirect taxes so much that it's still continuing. So with that inventory, which means why you will not have documentation. Not that they won't have information, but they would not submit that. Because they worry about having its retroactive effect on them. It's just a common sense thing with people. Market is there, clearly. My recommendation is that rather than create a middleman in the process, which is possible, easiest thing to do is to have prepaid mobile phones, which is already in place, and make that into a financial instrument also, which means the banks have to work with the cell phone companies. And I must tell you that I did that session in Malaysia. In ASEAN countries, this seems to be the drive now, which means the cellular telephone companies, mobile telephone companies, as you know, as utilities have a lot of cash coming in. They can become banks any day if they wanted to, if the governments will allow, and may become major alternative. As we said, Mr. Eapen talked about alternatives. Government is thinking about creating alternative systems in place so that actually there are more choices to access all these markets. I think that might be a way out. I'm sold on the cell phone as the mechanism for banking services.
So, any final thoughts? So in that case, let's wrap up. My sincere thanks to the panel.
The preceding program is copyrighted by Emory University.